morning, everyone. Now, welcome to Let's Learn Futures webinar series. This webinar series is brought to you by Bursa Malaysia and managed by our company, Excellent. Now, our topic for today is how to use volume and open interest to find bull and bear signals. I believe many of you heard before volume, but maybe open interest is a very new term to you. So our speaker for today, CY Saw, he's going to explain to you how to use those like volume and open interest to find your bull and bear signals. Now, for this session, we are going to have 90 minutes. The first 60 minutes will be covered by our speaker, CY Saw, and the final 30 minutes will be the Q&A session. Now, my name is Ting Ting. Before I start, please make sure that, can you please check your, can you please make sure that you can hear my voice, you can see my slides. If you can hear my voice and see my slides, can you please just type in the chat box 11? I repeat, if you can hear my voice, see my slides, can you please just type in the chat box 11? Very good, I can see many of you managed to hear it. Now, if you can't, you just please follow the steps, or else our admin will assist you accordingly. Now, as usual, please off your video because right now, nowadays, bandwidth will take a lot, especially when you open your video itself. I just give you 2 seconds. For those who are on your video, can you please just off it? Now, as usual, along the way, while our presenter is presenting, if you have any question, you do not need to wait until the end of the session. You can start to type in your question. Now, how do you send in your question? Please type your question in the Q&A box. Can you see this Q&A box? Just right beside your chat box. Please do not type your question in the chat box because later you're going to see that the chat box is going to move very fast. So to allow us to pick up your question, you must type your question in the Q&A box. You can ask in any languages. So you just need to click on the Q&A box, type in your question, and send it to all co-hosts. So I repeat, please type your question in the Q&A box because every session we still have some of the participants will send their question in the chat box. Now, besides today's session, every Tuesday, I'm not quite sure whether you're aware or not, maybe some of you attended before this LF Let's Learn Futures webinar series. If you never attended before, now every Tuesday we are going to have different topic, different languages covered by different speaker as well. For example, next Tuesday we are going to have a Malay topic, bagaimana indikator EMA boleh membantu trader membuat keputusan dalam trading. So followed by the subsequent Tuesday, it will be an English topic, from fear to confidence. So this is all about psychology itself. So you can scan this QR code, or else in the chat box, our admin will place the link. You can register accordingly. So once you register, then it will be automatically saved in your calendar, or else you can save it. At least you can remember when the date's drawing closer. So I'm going to give you 2 seconds, a quick one. You take a photo, later you can scan, or else scan first, keep the link, and you can register accordingly in a later stage. Now, besides Let's Learn Futures webinar series, we also have online workshop. Now, just a quick check. How many of you currently trading in futures? If you're currently trading in futures, can you please just type in the number of years that you have been trading in futures? Because later, I believe this will help CY as well. So for those who not yet get yourself started in futures trading, maybe can you please just type in 0? I repeat, how many of you are currently trading in futures? If you are currently trading in futures, you can type in the number of years that you are currently in futures trading. If this is your first class and you not yet get yourself started in futures trading, you can type in 0. I can see many 0 in the chat box. Now, for those type in 0, I saw someone 10 years as well. For those 10 years, congratulations. I would say that it's very minority of the traders will be able to exit maybe 3 to 5 years. So if you can reach 10 years, congratulate. some of the parts you must learn. I can see that many of you zero, meaning that you have no experience. For those who do not have any experience, this class is definitely for you because this LF online workshop is meant for beginners. So we're going to guide you through from zero until you will be able to send your first contract, meaning you can start your futures trading. So we are going to separate into two online workshops. The first session, we're going to cover the complete guide for beginners to futures trading with trading simulation, and followed by the second online workshop with how to create an effective futures trading plan and trading simulation. It will be on 9 on September. Please try to register as soon as possible because normally online workshop will run out of seat very soon because we're going to open to 150 online attendees. 150 registration, and on the day itself, only the first 50 online attendees will be accepted for the class because this class we're really going to step by step guide you through how to kickstart your futures trading. So for those who need to attend in Mandarin, upcoming 30th of September, Malay will be in October itself because we just finished one of the session, I think 1 or 2 weeks ago. So again, I give you 2 seconds. Please take a photo. You can share it with your friends for those who would like to start with their futures trading, or else you can use it for your own registration. Done? 1, 2. Now, this is our star for this evening. Now, I believe many of you already attended before CY class. I'm not going to introduce about him because many of you, I believe previously, you already attended his class. He's an expert in futures trading and also hedging itself. And he's also a chartered market technician, CMT chartered holder. He's currently the lead trainer for Excellent. Now, please allow me to pass it over to CY.
Good evening, everyone, and welcome back to our LF webinar session for today. I hope all of you are doing well and are ready to learn some valuable insights. And over the past few LF webinars, I constantly stress that it's important for you as a futures trader to understand the foundation of futures market and its structure. And I believe you may have already understand that stock market and futures market are entirely different markets and different trading products. Each of them with its own unique characteristics. And today I will be discussing about volume and open interest in the futures market. In fact, if you are able to utilize these two additional information in your analysis to analyze the market as well as to spot early bull and bear signals. And this is actually one of many techniques in technical analysis, which I believe many traders undervalue its importance. So whether you are new to futures trading or have some years of trading experience, it's okay if you don't understand today's topic right away, because this technique is considered to be advanced technique in technical analysis. So be easy on yourself. And in the next hour, I will be covering a range of topics, starting from the very foundational knowledge to application. I will also share with you some of my findings and experience in using this technique, what works and what does not work. I believe you will gain some practical insights on how to apply these ideas to your trading style and background. So let's get started. Before we begin, I would like to give you a quick disclaimer. This presentation is for educational purposes only, and it's intended to give you a high-level understanding of futures trading concepts. It's not a substitute for professional investment or financial advice. You still need to put in some effort and hard work on your side to study and develop strategies that suit your personal individual needs. That being said, I hope that today's session will help you expand and widen your horizon and knowledge of trading. Whether you are beginners or experience in trading, there's always something new to learn and discover. And I'm confident that you'll find value in the insights I will be sharing today. So let's get started. So as Ting Ting mentioned earlier, my name is Chun Yan, but you can just call me CY. And without further ado, I believe I don't have to introduce myself anymore. And let's directly, dive into the content and explore how you can take advantage of volume and open interest in helping you to analyze the market better. I will be dividing today's title into 4 key topics from foundation to application so that you can understand this better. So the first topic would be about understanding volume and open interest. Here, you need to understand the foundation first. I believe majority of you here are still new with the term open interest, am I right? You may not know what are the differences between volume and open interest. So you need to understand this clearly. Then, in the second topic, you need to understand how does open interest actually work? What is the calculation behind this? And with the third topic, I'm going to share with you the 6 basic interpretation for open interest with some examples so that you can actually grasp and see the value of this technique. And lastly, I'm going to share with you what works and what does not work for open interest in a Malaysia market. So are you ready to take your futures trading to the next level or not? So if you're ready, you can type in 1 in the chat box and we will begin soon. All right, great. Now, before we begin, let's take a quick poll. First question for you is that, do you analyze volume in your futures trading? So if you do analyze futures volume in your trading, you can type in yes in the chat box. If you completely don't see volume at all in your trading, you can just type in no in the chat box so that I can adjust my delivery method accordingly. Okay, I see some of you do look at volume, some of you do not. Okay, whether you look at volume or not, later on I will be touching a little bit on volume, and we will be going to see whether, looking at volume, whether there is provide value for you in futures trading or not, because sometimes volume may provide good information, sometimes volume does not provide good information. So you need to be able to know what information that is important for you in futures trading so that you are able to make better decisions. Now, the second question for you is that, of course, for those of you, I'm not quite sure whether you understand what is open interest or not. How about open interest? Do you use open interest in your futures trading? If you don't use open interest at all, you can just type in no in the chat box. Okay, majority don't use, right? A very minority actually use it. I see. Okay, I believe some of you may be actually, scratching your head and even roll your eyes up and thinking and wondering what is actually open interest. Some of you may not heard about this word at all. All right, don't worry about it. If you don't understand it, it's okay, because I will start from the very basic, the first topic, as simple as possible so that you can understand the core concept behind it. Now let's begin with the basic concept first. Here, all you need to understand is just only a few things. What is volume and what is open interest? And you need to be able to differentiate between a volume and open interest. And in what conditions you need to use open interest in analyzing the market. First thing first, let me set the stage here. Number one is that volume and open interest are commonly used as secondary indicators in technical analysis for you to gain additional insights into the market dynamics and understanding the market sentiment. So volume and open interest are not primary indicators like price or moving averages, because although these two indicators, they can provide valuable information when analyzing price movement and making trading decisions. So to make it simple, the first thing you analyze the market is not volume and open interest. Okay, the first thing that you need to analyze the market is actually price and direction. Volume and open interest comes later. They are secondary. So it's important for you to get this correctly. So if you would like to use open volume and open interest in your analysis, make this as your secondary indicator, not your primary indicator. Okay, primary indicator is always looking at price and a direction first. In technical analysis, in trading, there are important things that we look into it first, and there are also things that are not so important. We look at it at a later stage. So in technical indicators, there are primary indicators and secondary indicators are used to analyze market data and making trading decisions. Primary indicators, also known as price-based indicators, they are directly derived from your price data, your opening, high, low, and close price. And they provide insights into the current and future direction of prices. They are used to identify trends, reversals, and even potential entry or exit points in the market. So examples of primary indicator include trend lines, support and resistance lines, uh, moving averages, MACD, RSI. All of these indicators are use price as a calculation. So these are primary indicators. Whereas for secondary indicators, there are actually a few types: volume-based indicators or strength-based indicators. Today, I will be mainly talking about volume-based indicators. These indicators provide additional insights to support and confirm the signals generated by your primary indicators. So volume indicators are derived from a volume data, of course, and they help assess the strength and the weaknesses of price movements. So example of secondary indicators include volume and open interest. They all offer a broad perspective on the market dynamics, particularly in looking at the level of participation and interest among market participants. So it's important to take note that although secondary indicators are useful, they should not be used in isolation. You cannot use secondary indicator as standalone, because secondary indicators, they are most effective when used in combination with your primary indicators such as trend lines, chart patterns, and also even fundamental analysis for you to make a well-informed trading decisions. Now, you need to understand that the differences between stocks and futures. Now, I understand a majority of you coming from stock trading experience, right? So, which is why when it comes to futures trading, there is something a little bit different compared to the stock market. So here you need to be able to differentiate what is the difference between stock as well as futures. Now, the first thing, in stock market, you trade company shares, right? So the total number of issued shares of a company, usually it remains constant. Okay, if the company don't issue any rights or don't issue any new shares, the shares typically remain constant. For example, if a company issue 1 million shares, only 1 million shares will be actually exchanged hands in the market, regardless of how many volume is being traded. So no matter how many shares you buy and sell in the market, the number of shares for that particular company remains the same. So for example, when you enter the stock market, you buy shares in order to own it. And when you exit the market, you sell every shares and you don't own anything. Whereas for the futures market, you trade futures contract. The number of outstanding futures contract, it can changes from day to day. So there is no limit of contracts available in the market. In fact, it is actually considered as quite unlimited. You do not know how much futures contract can be traded in the market. Meaning, once you enter the futures market, you are actually creating futures contract there. So of course, when you open position in the futures market, you can long or even short the market. And when you exit the futures market, well, it depends on what is your previous entering position. You can long and short in order to close your position as well. Now, of course, for this, I would move a little bit quicker. What is actually volume? In fact, volume is actually, I believe majority of you know already, is actually the total number of shares or contracts traded in a single day. So of course, it represents the trading activity or liquidity of that particular market. And of course, the most important thing is you need to know how volume is actually calculated. So for example, let's say if you are doing intraday trading, when you enter the futures market with 10 lots, for example, you contribute 10 units to the trading volume. And when you exit 10 lots from the new futures market, you will contribute another 10 units of trading volume. Okay, so in total, you have contributed 20 units of trading volume in that particular day itself. Okay, at the end of the day, you don't hold any positions. So you enter the market 10 lots, you exit 10 lots. So in total, you contributed 20 lots of trading volume in that day itself. So for can understand here. And thirdly, why volume is actually important? Of course, it is generally used as secondary confirmation in order to confirm the trend, in order to confirm the price movement. Volume can also be used to identify whether the market is actually hitting the floor or the ceiling. Now, this is a typical chart for FCPO market. And below this chart, you can see a lot of bars, right? And this is how volume actually look like at the bottom. It's a bar chart. You can actually add volume into your chart. Higher bar means higher volume. Lots of contracts are being traded in that particular day. And low volume, low bar means low volume. Lesser contracts are being traded. Now, open interest. And do you know what is open interest or not? So for those of you who know what is open interest, can you briefly share in a very short, quick sentences, what is actually open interest all about? Whereas for those of you who do not know, you can also have a quick guess what is actually open interest. If you know the answer, you can type in the chat box. Okay, when it comes to open interest, the name actually implies itself already. So when you understand basic English, it's very easy for you to understand what is open interest. Okay, I see some of you put buy and sell or order open position. Open position is correct. Okay, I see some of you have different answers. All right, simply speaking, open interest is very simple. You can ignore this long sentence. Very simple. Open interest is actually any contracts that are not closed yet. Okay, because futures contract, it comes from zero, right? There is no limit. There is unlimited futures contract that you can create. So as long as you enter the market, you will be creating a futures contract already. So as long as any contracts that the market participant has opened and not closed yet, those are what we call as open interest. You have already opened the contract but not closed yet. All right. So how is open interest being calculated? Let me use back the intraday trading example just now again. When you enter 10 lots in the market, you will be creating 10 units in open interest. Okay, so far can understand. And when you exit 10 lots in the market, you minus 10 units from the open interest because you have already closed those 10 contracts. So in short, your contribution to open interest at the end of the day is actually zero. Okay, I repeat again. When you enter 10 lots in the market, you add 10 units of open interest. It is similar like volume. However, the difference is that when you exceed 10 lots in the market, when you close all of the contracts that you open, you minus 10 units of the open interest. So in net total, you are actually contributing open interest at the end of the day is actually zero. All right. So to make it simple, open interest increase when people enter the market. Open interest reduce when people exit the market. So very simple. It's like, you, for example, you treat a market is like a room or a shopping mall. When people go in, open interest increase. When people come out from the mall, open interest will be reducing. Okay, so this is open interest. Whereas for volume, it is like how when you in and out of the mall, right, there will be, for example, there will be a bell on the gate or the door there. So once you enter, there will be one time ding dong. When you exit one time, there will be another time ding dong, correct? So volume is like counting how many times does the bell actually rang. But open interest is actually calculating how many people is actually in that particular room or in the market. So why open interest is actually important? It actually gives you information about traders' participation in the market. So later on, I will be explained in detail in the next topic, because when it comes to futures trading, volume can be it will only keep increasing. So there are times at the end of the day, you're not quite sure how many people is actually holding the contract, because intraday trader, for example, if you trade 100 lots in the market, and by the end of the day you close 100 lots, so you will be creating 200 trading volume, but open interest you're actually creating zero. So something very different for futures market is that we are actually interested to know how many people still remains in the futures market, that is still holding, whether is it their long position or their short position. So this is how our open interest looks like. Again, it's like a bar chart, like volume. However, if we put side by side, comparing open interest and volume, it will be looking like this. So of course, for the top bar, this one would be open interest, and at the bottom would be your volume. So here you may see that it looks quite similar. However, it is a little bit different. So I guess you may be having some question in your mind already, right? Both open interest and volume looks the same. Why do we still need to look at open interest? Now here, if I were to zoom in a little bit, I'm not quite sure whether you're able to see here or not. The value of open interest and the volume is actually very different at the far right hand side of the particular singular day. The open interest, it's actually around 49,000 that is not closed yet, meaning there are 49,000 futures contract for FCPO. It is still remaining open and not closed. Whereas the trading volume for that single day, it is only 4,600. So both have different stories to tell. And of course, when it comes to open interest, later on in the next topic, I will be explaining to you how their open interest actually work in the market. Now, in this topic, you need to know how does open interest work and the mechanism behind it. So to make it simple, open interest represents how many outstanding long or short positions in the market, but not the combination of both, okay? So for example, if you have 50,000 long contract in the market, it also means there is in total, there is only 50 open interest in the market, because for every person who long the market, the other party which is actually shorting the market. So it is only when we mention about 50,000 open interest, it also means both altogether long and short contract in the market. So to make it simple, open interest is the number of contracts already open but not closed yet. Of course, in futures, a contract must both have buyer and seller. So which is why two market participants, a buyer and a seller, combined together, it only create one contract. Okay, one contract is actually a pair of buyer and seller. So at the end of the trading day, the open interest can either increase or decrease in the number of contracts for that day. However, volume will only keep increasing if there is a lot of transactions happening in the market. So it is those changes in open interest level, either up or down, it actually gives traders a clue about the changing sentiment of market participants. Now, how does open interest actually occur? In order for you to grasp the significance of how changes in the open interest number are interpreted, you must first understand how each produce a change in those numbers. Of course, every time a trade is completed, open interest is affected in one of these three ways. Either it can increase, decrease, or stays unchanged. So let's see how those changes actually occur. There are only four conditions or four situations. So let's look at these four situations. In the first case, both buyers, new buyers and new sellers are actually entering a new position and a new contract is actually created. So both parties enter the market. So there is an increase in market participants. Open interest will increase. And the next one, I will temporarily skip case number 2 and case number 3 for a moment, and I will come back to this later. I will straight away jump to case number 4. It's easier for you to understand that way. In case number 4, is that the same buyer or other sellers, both of them, they are closing their existing position, regardless of a long position or short position. Both of them are closing their short position, their own old position in the market. So the open interest would actually decrease accordingly. Okay, so number one and number two, number one and number four would be easy for you to understand. When people enter the market, open interest increase, and when people exit the market or close their position, open interest would reduce. So now comes to case number 2 and number 3. Case number 2, buyer, new buyer entering the market, but the seller is actually closing their old long position. So one person enter and another person exit. So the net effect is no changes take place in the number of contracts. It remains the same. Similarly, in case number 3, the same thing happens, except for this time, it is the seller who create a new contract, and then the buyer is actually closing their old contract position. Because one is entering the market, another one exits. Again, there is no changes in the number of contracts. So to make it simple, if both buyers, okay, and sellers are opening new position, open interest increase. If both are closing an existing position, open interest will decline. If one person open, another one close, then open interest will remain unchanged. So in short, by looking at the net changes in the total open interest at the end of the day, okay, at the end of the day, not during the day, because when you look at open interest during the day, open interest would usually increase, and at the end of the day, open interest would suddenly drop. So when you want to use this technique, it would be more applicable when you look at the open interest at the end of the day. We want to see what is the changes in the net changes of total open interest from day-to-day changes. So for you as a trader, you will be able to determine whether the money is actually flowing in or flowing out of the market. How many people enter the market and how many actually exit the market. So this information will enable you to draw some conclusions about the strength or weaknesses for the current price trend. Now, the basic interpretation of open interest, very simple. When you see open interest increase, it means more people entering the market. They are committed in a particular direction. On the other hand, when you see open interest decrease, it means lesser people are remaining in the market, because it's like, you know, a stadium. You imagine a stadium is like a market. When people entering the stadium, which means people are interested in participating in the market, right? And when people leave the stadium, so open interest will actually decrease. So which means less people are interested to be in the market. So of course, back to the very simple English is that, you know, open interest is the total number of contracts that has not closed yet. Of course, open means opening position, and interest here it means is that, you know, if you're interested in a particular market direction, right, whether the market, for example, the market is going up, so you will be opening a long position. And it also means you have a commitment in the market. So open interest, the term is, you know, specifically only used in the derivatives market. When you trade futures or trading options, because you are trading standardized contracts, right? So open interest has its actually own meaning there. It provides you insights on, you know, the overall interest of position held or opened by the market participants. So in short, Open interest is used as an indicator for futures trader to determine the market sentiment and the strength behind the price trends. Now, thirdly, now that you have already know what is open interest, the mechanism of it, and the basic interpretation, and now we are going to apply this concept with some examples. So here, there are 6 ways you can analyze open interest. Of course, when it comes to interpretation, it will be subjective. Interpretation is an art. And like any other technical indicators, there is no 100% accuracy in this, because remember, open interest is just another information for you in trading to be used as a secondary indicator. Open interest can give you, different outlook about the market trend. So it takes a lot of practice and trading experience for you to be able to interpret it accurately. Now, there are 6 rules for analyzing open interest, and only these 6 conditions. Condition number 1, 2, 3, and condition 4 would be easier for you to understand. Number 5 and number 6, sometimes it happens in the market, sometimes it rarely happens. So all you need to be familiarized yourself is actually rule number 1 and until rule number 4. So let's have a look at rule number 1 first, and later on in the next slide, I will be explaining each of these rules with example. So the first rule is that if price goes up and open interest increase, it means the market is actually it's actually bullish. Okay. Rule number 2 is that if price comes down and open interest increase, meaning the market is actually bearish. More bears are actually entering the market. Rule number 3, if price continues to go up, but open interest is reducing, of course, this indicates that the market is beginning to turn bearish. In other words, market participants are starting to leave the market. The bulls are starting to leave the market, and then the bears is starting to coming in. Rule number 4 is that if price continues to come down, but open interest is reducing, so of course this is the opposite of number 3. It signals that the market is turning bearish. So market participants are not so much, they don't have so much interest in selling anymore. The bears are slowly leaving the market already, so that bulls can come in. Rule number 5 and number 6. Number 5 first, if the market goes sideways, but open interest is rising, of course, this signals a bearish market is going to come soon. And rule number 6, if the market goes sideways, but open interest is falling, this would indicate that the market may be bullish soon. So here you need to just familiarize yourself with rule number 1 until number 4. Patterns are actually good enough. Rule number 5 and number 6 at times are difficult to interpret. It's easier for you to identify when rule number 1 and rule number 4 happens. Number 5, number 6 are difficult to interpret. So let's have a look at rule number 1 first. Now, of course, the first rule, when price goes up and open interest is rising, it indicates a bullish sign. So here you can see that in this situation, when the bulls are actually in charge, buyers are actually actively buying. More bulls are participating in the uptrend. Okay, more bulls are actually entering the market, and they may also be adding buying positions. So, which is why buying pressure is actually stronger, causing the prices to go up. Whereas the bears are actually passively selling because they are higher price, right? So for sellers, of course, they want to get as higher price as possible. So selling pressure is actually lower. So as the market continue to rise, the bulls are actually getting stronger and the bears are actually getting weaker. So here you can see when price goes up, open interest would actually go up. Price goes up, open interest would actually go up. Okay, because when there are more bulls entering the market, of course, eventually it will create a strong buying pressure, leading, causing the price to go up. So with this example, if you are just, if you don't look at open interest, if you are just looking at a price itself only, you may not know what is actually happening behind. You do not know whether the bulls are increasing or the bulls are decreasing. So here, with open interest, you can more or less have one indicator to gauge whether in this particular market, how many are actually bullish in the market, or whether traders are bearish in the market, how many bulls enter the market, and how many bears are actually leaving the market. All right, so I see there are some questions here. What does the blue and the red line show here? The blue means increase in open interest. Red means comparing to yesterday, open interest is actually lower. So blue means increasing open interest. Red means red bar means reducing open interest. Now, the same example, the same rule for example number 2. Another example for a bullish sign. Price is going up, open interest is rising. So here you can see, for example, this is moving average, commonly used moving average, 20 days. When you see that, price is actually, when you are able to identify an uptrend and open interest here is actually increasing, it means that more bulls entering the market already, creating a higher bullish sign. Okay, so it's rule number 1 is very easy to identify, especially when there is an uptrend. So rule number 1, remember this: when price goes up, open interest also goes up. It means bulls are there are more bulls than bears in the market, so it is a bullish sign. Okay, again, you can see price goes up and open interest goes up, so it is a bullish sign. Now, rule number 2 is the opposite of rule number 1. So this is what we want to look at: how many bears are in the market. Rule number 2, when price comes down and open interest is rising, so this indicates a bearish sign. So all you need to remember is that, when price comes down and there are more bears in the market, of course, definitely the market is a confirmation for you to say that, the market shows a bearish sign. So in this situation, the bears are in charge. You can see that, here, when price below moving average is considered downtrend, right? So here you can see that, at this point, the open interest is slowly increasing day by day. In this situation, the bears are actually in charge. Sellers are actively selling. More bears are participating in the downtrend, and the bears may be adding selling position as well. So selling pressure is stronger, and the bulls are passively buying. So the buying pressure is lower. And as the market continues to fall, the bears are getting stronger and the bulls are getting weaker. So it's like, when we're talking about bull and bear, it is like an analogy about, a tug of war, whether the bull is stronger or whether the bear is stronger. So when there are more bulls than bear, it is an uptrend. And when there are more bears than bulls, then it is a downtrend. So similarly, like rule number 1, if you're just looking at the price chart only, yes, you are able to identify uptrend and downtrend, but you may not know what is actually happening behind. You do not know whether the bears are increasing or decreasing. So here for rule number 2, very simple. When you see downtrend and open interest is rising, so general rule is that, bears are actually increasing. Another example for rule number 2, here you can see that, at the top, of course, you are able to identify where is downtrend, right, in this chart. So here you can see it is a downtrend. The open interest is actually increasing. Second position here, you can see that, although price crossed above moving average and then it crossed back down again, here maybe uptrend in that particular day and then downtrend next day, right? Here you can see that again, open interest continue to increase. So it confirms again the bear is still winning in the market. So it is still a downtrend. Another one here, although it goes up, uptrend for a few days and then the price comes back down. the moving average, you are able to identify downtrend again, and you can see the open interest here is actually increasing. So you can see open interest is a confirmation for you to identify how whether the market is actually bear or bull, whether bear is more or bull is more in the market. So in this case, rule number 2, price goes down, open interest is increasing, means that there are more bears is actually in the market. So if you want to try to be bullish in the market, is actually quite risky. So always follow the trend of the market. So rule number 1, rule number 2 is easy for you to identify, right? So now let's go to rule number 3 and rule number 4. So the third rule, when price continues to go up and open interest is reducing or falling, and this indicates that the market is turning bearish. So in other words, in an uptrend, the bulls are starting to leaving the uptrend already. The bulls are starting retreating already. So I give you an analogy here. Okay, look at this example first. You can see usually this happens almost at the end of an uptrend. Price still remains going up. You can see going up, but the second you can see here is considered like a double top, right? First top and then the second top. So you can see that for the second top, the open interest is actually reducing already. So what does that mean? Here, it actually means that, the existing bulls are, those who long in the market, they're actually taking profit and closing their position. So which is why the open interest is reducing. And of course, usually, these are what we call as the smart money. They are called smart money because most of the time they have been right up to this point, and they are replaced by new buyers who is actually weak, and new sellers who are actually very strong. So here you can see it from the open interest for the second round of the high price, but the open interest here actually drop. And the third round, again, you can see, when price goes up to try to test on a particular high, again, the open interest here is actually reducing. And here you also may able to see the open interest at this particular time is actually way lower than the previous first time high of the open interest. So here you can see that it gives you a double confirmation to signify that the uptrend is almost end already. The bulls are getting tired, so it signifies that the smart bulls are no longer interested in joining or participating in the uptrend. So after an uptrend rally, these rules usually applies, and it indicates that the uptrend is ending soon. Okay, to make it simple, for example, it's like in an uptrend, when a lot of people, when a lot of bulls charging in front forward, right? So you can see like, oh, the uptrend is actually strong. But sooner or later, you will see that, some bulls are actually tired already, right? So less and less bulls are actually moving forward. Some people are actually, retreating from the war already. They are, your army is actually getting lesser and lesser. So of course, the uptrend will be weak. So uptrend weak means downtrend is actually it usually signifies it's a beginning of a downtrend. Another example, number 2 for rule number 3, which is when price is uptrend, open interest is falling, it signifies a bearish sign. So of course here you can see it is an uptrend. Almost at the end of the uptrend, the open interest is actually falling. Another one, you can see when price keeps going up higher, but open interest is actually falling. It usually indicates is that that the bulls are actually tired. They are no longer interested in the market already. So which is why they do not want to open a new position, uptrend position anymore. So remember this rule: price continues to go up, but the open interest starting to reduce. This indicates that the market is turning bearish. Bulls are starting leaving the uptrend market. Now, rule number 4 is the opposite of rule number 3. Very simple. It's a mirror image of rule number 3. So here you can see is that when price continues to come down, but open interest is actually reducing. This signals that the market is, beginning to turn bullish. market participants are not so interested in selling anymore. So initially, during a downtrend right here, during a downtrend, there are more bears participating in the market. So sooner or later, bears are getting tired. They may be taking profit, and you may see that the phenomena is that the bears are starting to leave the market. So when bears starting to leave the market, it means that the open interest would be reducing already. So again, here, the smart money, the shorts, those who are taking short position, they are covering their short position or they are closing their short position. So the bears are beginning to leave the market so that new bulls can actually come in. So you can see the decline in open interest indicates that the number of bears are reducing, and they will be replaced with newer bulls, which may be stronger. Another example for rule number 4, price continues to go down, but your open interest is getting lesser and lesser. So meaning bears are slowly leaving the market. So in other words, it also means that bull is actually coming in soon. And of course, rule number 3 and number 4, this usually happens after, for rule number 3, it usually happens an uptrend rally, then rule number 3 only applies. Rule number 4 only applies it's when after a persistent time of downtrend. So this indicates that the downtrend is ending soon. So rule number 5, of course, rule number 5 and number 6 I've mentioned already. It's a little bit hard to identify because it is a sideways market. Usually, when it comes to a technical analysis, uptrend and downtrend, it's very clearly confirmed. It's very easy to identify. It's just that sideways, it's something very subjective and something difficult to clearly identify. So rule number 5, when price goes sideways and open interest is rising, it means a bearish sign. So here you can see during a sideways, and then open interest is actually rising, and this is a bearish sign. This is actually rule number 5 is a unique case, and quite seldom happen for FCPO market because it's difficult for us to clearly define a sideways market, because when a market bounce up, you think that it's an uptrend market, right? Here when the price bounce up, you think that price may continue to go uptrend, but it comes down, you think it's a downtrend again. So of course, sideways market is it's going sideways and ding ding dong dong. You do not know when does it actually ends. So rule number 5, this situation is a bearish sign because public retail traders generally place on the long side with the bulls. Okay, and in this case, when you see sideways and rising open interest, you can't really tell how many bulls are entering or how many bears are in the market, right? But there is one rule of thumb you can actually follow. Rising open interest in the sideways usually assumes that hedgers are taking the short position. Hedgers want to protect themselves, so which is why there most of the time hedgers would actually take a short position to protect price coming down. So which is why you can see there would be increase in open interest. Now, rule number 6, last rule number 6, when price again it's a sideways and open interest reducing, it's again this rule is opposite with rule number 5. It usually indicates a bearish sign. If market goes sideways but open interest is falling, it indicates that the market may be bearish soon. So you can see here, market sideways, open interest comes down. Soon enough, when price goes up, and again going back, if we apply with rule number 1 again, price goes up, uptrend, increase open interest is an uptrend. So here you can see when it is an uptrend, open interest may be increasing. Another example here, sideways, reducing open interest. When the price comes back uptrend again, your open interest increase. So there would be a confirmation for uptrend. Now, how long will the uptrend last? We do not really know. But all we can know is that there are actually more bulls than bears in the market. So in this situation, it's actually bullish sign because the professionals and hedgers who have short position, they are likely to covering or close their short positions because in their commodity business, demand for commodity is actually coming in. So they would want to reduce their short positions. When back to the fundamentals, can you tell me when demand comes in, what would the price be? Will the price go up or come down? Okay, remember smart monies are usually those who are actually in the physical business, whether are they commercials or producers in the market. So back to fundamentals, when demand comes in, price would generally go up, right? So you can see when during sideways and open interest comes down, means that the short position would be actually reducing. So of course after that, when price goes up with an increase in open interest, it confirms that uptrend is actually it's a beginning of an uptrend. Okay, same thing, sideways, reducing in open interest, although of course another one, you can see that some of these rules does not apply. It does not happen 100% all the time. So you can see this is actually a failed example for rule number 6, because of course when you apply these uh, 6 rules to analyze open interest, okay, you still need to make sure that your trading strategies need to have a proper risk management, okay, because there is no fail proof of technical indicators or analysis. There will be time, even with you interpret it correctly, the price still goes the other way. So of course you need to be able to manage your risk in futures trading. So of course for this example, last one here it is actually a failed example, but however you can see that you can see it's an reducing open interest with a downtrend. It signifies that the downtrend is actually ending soon. So when the price breaks up and confirming an uptrend with an increase in volume, so go back to rule number 1, it is a bullish example. Another example here for rule number 6 is that when sideways reducing open interest, it means that the market is actually bullish soon. So you can see when price cross above, it is an uptrend. Another example, sideways with a reduced open interest, and then when price breaks up with an increase in open interest, it means we go back to rule number 1 again. It is a bullish signal. All right, so here you can take your phone to screenshot this page. Here are the 6 rules for analyzing open interest. So you just need to familiarize yourself with rule number 1 until rule number 4. Of course, when it comes to interpreting and analyze or even reading the market, you need to know rule number 1 until rule number 4. It's more than good enough already. Okay, so here you just need to familiarize yourself with rule number 1, 2, 3. These 4 patterns are actually good enough. Rule number 5 and 6 are most of the time are very difficult to interpret, and you may interpret it wrongly. So personally for me, rule number 5, there are times I interpret it incorrectly, because we as a trend trader, you want to trade with trends, right? So which is why rule number 1 and until rule number 4, usually it's that we want to trade following with the trend or spotting reversals. So now that I've already shared with you the 6 rules for analyzing open interest for the FCPO market, now you may be wondering, all of the examples I provided here are only for FCPO market. Now, how about the FKLI market? You may be wondering, how about FKLI market? Can we actually look at open interest or not? Of course, there's a catch here. Now, here I'm going to share with you what works and what does not work. So topic 3, I have already shared with you what works in the FCPO market. So the 6 rules, basic rules, definitely it applies in FCPO market. Now, here I'm also going to share with you what does not work in, at least in Malaysia, futures market. Now, before that, one question for you, before I share with you what works and what does not. Can you use the same tool or strategy or even technique to trade every single market or not? If you can use it, You can type in yes. If not, you can type in no. There is, of course, there is no right and wrong answer here, because of course, for those of you who answer yes, you have your reasoning behind. For those of you uh, answering no, there is reasoning behind. So of course, you know, you more or less would be able to guess what answer I would say, right? The answer, of course, would be the standard answer. It depends. But a more accurate answer I would actually would like to tell you is that it the answer would be yes if that particular strategy or tool or even technique works for the market. If it works for the market, use it. If it does not work for the market, don't use it. Okay, very simple. I repeat again. If a tool or strategy or even technique used or applicable for that market, use it. If it does not work or proven to be, out of 10 trades, you lose 8 8 out of 10, 9 out of 10, it means it proven that it does not work. So don't use it. So of course, all tools and strategies and techniques have to be customized for the market or the whatever product that you trade. Always remember this general rule. Okay. Now let's go into the futures market. Now for futures market, index futures FKLI, you can look at this chart here. We have open interest as well as volume for FKLI. On the top would be open interest, the bottom would be FKLI. You can see that the open interests are relatively quite flat for almost each and every single month, right? So here you can see that, if every month is actually quite flat about the same figure, you can't really apply any of these 6 rules that I have shared with you just now. And also, you can see that at the end of each month, okay, if you're sharp enough, you can see at the end of each month, there will be actually a spike in volume. You can see at the end of the month, there will be a spike in volume here, okay, which I've already highlighted out with this signal. And after a spike, there would a big drop in open interest. Okay, you can see here there is suddenly a big drop in volume, a big drop in open interest also. Okay, a big drop. So of course, remember you are trading futures market. So at the end of the month, what really happens in futures market is that, again, back to the very fundamental of futures market, is that futures contract will expire. So this is where market participants are actually rolling over the futures contract. So before the end of the before at the end of the month, market participants will roll over, so which is fine. That probably explains increase in trading volume for a short moment, and then at the end of the day, 1 day or 2 days at the end of the month, volume, this open interest will suddenly drop very significantly. Volume drop as well. So using open interest in this case does not have a meaningful interpretation for a trader. So for FKLI, I've already shown you some evidence here whether is it meaningful for you to interpret open interest or not. So of course, if open interest you can't use, what can you actually look at? Just now I've already showed you open interest and volume for FKLI. It does not show you meaningful interpretation, right? But if you would like to trade FKLI, if you're trading FKLI, I think it would be meaningful for you to actually looking at the underlying trading volume, which is the FPMKLCI, the index itself. The FPMKLCI, the day-to-day trading volume, not the FKLI volume. Now back to very foundation of volume. How do you interpret that? Is that, for trading FKLI, you can use the general rule of thumb of, how you identify volume in stocks, which is using this technique. It's a general rule. When the FKLI is rising and the trading volume is actually falling, so of course again it indicates that the bear is actually the bulls is actually leaving the market already. Okay, when price is rising and volume is falling, it means that the market is weakening, uptrend is ending soon. On contrary, when the FBMKLCI is falling and the trading volume is rising, you might be wondering, price is falling, right? But how come people is still be interested in the market? Of course, those are smart monies. It indicates that the market is slowly strengthening and downtrend is ending soon. So with this general rule, you can use this for spotting potential reversals for FKLI, and also for if you trade stocks, also for the general stock market as well. So of course, back to the underlying, which is your FPM KLCI. So of course, this is a year 2000 during the COVID period, right? So you can see when price comes down, a very sharp drop, and you can see the volume is actually increasing. So you might be wondering, it's actually a very, a thing and opposite psychology. Price comes down, most of the time people are fearful of the market, right? But how come does the volume actually increasing? It means somebody is willing to buy at that particular price, especially a very unusual spike in volume. So it indicates or signaling a bullish reversal. Bull is the bear is ending, the bull is coming in the market. So of course, when increase in volume here, you can see that the market actually bounce back up. Another situation when price is up here, but the volume is slowly coming down already. You can see that here the second top compared to the first top, the volume is actually less, relatively lesser. It signifies that it's a bearish reversal. The bulls are tired and bears is starting to coming in, and you can see here there is a short term of bears coming in. Here is a what we can see is a downtrend. Another example here, which I believe it's quite recently, which is the price continues to go up. But here you can see the spike in volume. Each and every time when there is a spike in volume, it is actually getting lower and lower. So price goes up, volume comes down. It is signaling the bearish reversal. Bear is actually coming soon. So of course, this as you can see in our Malaysia FPM KLCI, ever since COVID, it has went down very low before, and it bounced back as high as I think it's around 1,700 points, and that is actually by until today, that is actually the highest point. So of course, the rest is history. You do know that now it's 1,500 plus. Now, of course, remember before I end today's sharing is that remember volume and open interest, it is generally used as secondary indicator only. Always identify your trend using the primary indicator first. Then only you look at your trend strength through volume or even open interest. So there you have it. Let me summarize what I have shared with you today. Of course, the first thing, open interest is open position. Opening position means that people are interested in the market that are not closed yet. Number two, open interest can increase or decrease. Increase in open interest means more participants are joining the market. Reducing in open interest means less participants join the market. And I have shared with you the 6 rules for analyzing open interest. You just need to familiarize yourself with rule number 1 until rule number 4 only. And these 6 rules, it's applicable for FCPO market. And of course, for FCPO market, you can use the 6 rules. But for trading FKLI, it will be better to look at the FPM KLCI volume itself. All right, so that's it for today that I have shared with you. Of course, when it comes to good trading psychology, you need to begin to have the right education. So when you understand how does the market works through right education and knowledge, although I do understand that education costs you time, effort, and even maybe money, but of course ignorance about the market can actually cost you even more. So if you don't have the right knowledge and right education, there would be a lot of disturbance that is disturbing you in your trading psychology. So always, begin with the right knowledge and education.
Right now, by now, you should be able to understand what is open interest, what is volume. Maybe are you able to really answer that or not? But just now, I believe you are very clearly explaining what is the difference between open interest and also volume, and when you need to use open interest, when you need to use volume, especially applies in Malaysia futures market. Now, before I continue, any question that you would like to ask, you can start to type in the Q&A box. Again, you can go to the Q&A, you just click on the Q&A button, type in your question and send it to our co-hosts. Now, while waiting for your question, can you please do a favor? Just scan this QR code. You just take your mobile phone, scan this QR code and provide us with your feedback. This feedback is very short, roughly about 30 seconds to a minute. You should be able to finish. The only things that we require from you for this session is to provide us with your feedback, because your feedback is very important for us to progress and also to do it better in the next session. So I repeat, there are two ways. Either in the chat box, there's a link. You can click on the link to provide us with the feedback, or else you can take your mobile phone and scan this QR code and provide us with your feedback. While if you are having any question, you can start to type in your question. We are going to answer your question. Remember, through Q&A, that's the best part for you to learn. And remember, when you type in your question, please type in the Q&A box. Please do not type in the chat box. So we have some very interesting questions already in the Q&A box. We are going to pick up those questions, and because some of the questions are repeatable, so we are going to summarize and refer those questions for CY to answer in a short while. Last 30 seconds. Okay, while you are doing the feedback form, we are going to start with the question. Now, CY, are you ready?
Yeah.
Now, let me summarize, because here there are many questions, right? Different people asking the same question. Let me pick up the most common question. First, where can we insert or use these indicators in any of the trading platform? Maybe you can list any of the trading platform that they can use the volume and also the open interest, because I believe many of the trading platform or even some of the service provider available in the market, I believe they do not provide those open interest indicators and also volume. Maybe can you elaborate or not?
Yeah, that's true. Glad that you asked that question. Okay. So of course, in the presentation, I didn't mention where to find right open interest. So it's a very good question. Of course, for Malaysia market, you're trading Malaysia futures. Of course, it would be best to use your own brokers platform. I think Malaysia, there are two commonly used charting vendor, right, which is by end-to-end or using NextView as a charting vendor. So where to find your open interest? You can open your chart and look at the indicator section where you find your, where you insert your volume, moving averages, Bollinger Band. You'll find the category O or O there, okay, alphabetical order, to see whether there is an open interest section or not, together with your volume. So this is where you are able to find open interest. So I'm not sure whether end-to-end has charting platform has open interest or not, but for next few charting platform, yes, you do have open interest. Posta Station, I'm not quite sure whether they still open for any subscription or not. Definitely there they have an open interest indicator for you to look at. So of course, otherwise, because open interest, it is not any secret information. It is a publicly available information. So if you are not able to get all of this information, in fact, you can actually go to this Bursa website to download their day-to-day data, open interest data, because Bursa each and every day, at the end of the day, they will definitely publish what is the opening, high, low, close price together with volume, as well as the end of day open interest.
Okay, since you are answering that, many specifically asking about TradingView because this is a free platform. So they are asking whether does TradingView provide this open interest and volume indicators or not?
TradingView, yes, they does provide. I think I've already tried before TradingView. There is open interest and volume for Malaysia futures market. However, I think when you click on it, there is no data appearing. So I'm not quite sure whether you need to pay for subscribe to Malaysia data in TradingView or not. So I did not subscribe to the real paid data for TradingView. So if anybody who knows whether the subscription version for TradingView, especially Malaysia futures market data, right? Probably you can share with us whether it does provide open interest or not. So far as I know, those the free version of TradingView, there is you can click on the open interest, but nothing shown there.
Okay, so in short, in Malaysia, we are not selling any of the platform, but it's just for information to summarize what CY has mentioned just now. Basically, TradingView, maybe if you don't pay it, it is not available. For Bursa Station, for NextView, definitely they available those data for your usage. Now, the second question that they're asking is for this open interest, you're going to look at individual month or you're going to look at totality?
Okay, of course, for open interest, when you look at your trading platform, right, with all those tables, you can see for all trading months, there will be one section, one column down there would be saying OI. Okay, depending on your trading platform, sometimes they put OI means it stands for open interest, or sometimes they would be using the full word as open interest. So this OI, that is actually open interest. Each and every month there would be open interest in it. So of course, the most relevant for us, or maybe for you as retail trader, is that you are trading the third contract month for FCPO and the spot month for FKLI, right? Only look at the open interest for the contract that you trade. That is good enough. The rest of the month, you are not trading that month, right? So it's not relevant for you to even look at it. But one thing you can see that how come even 5 months, 6 months ahead, 12 months ahead, there would still be open interest is actually retail traders don't trade that. Usually those are the hedges who enter the market for hedging purposes. So this is where they are opening a position in further month for their hedging purposes.
Okay, the next question is referring to the slides just now you have presented. I'm not quite sure. I think it's towards the end. He's asking, is the concept somewhat similar with divergence, price versus open interest?
Yes, yes, it's similar, exactly the same. It's as divergence. So of course, I think I shared with you rule number 1 and number 2 is price up, volume up. It's a convergence, right? Price down, volume down. Price down and volume up, it's a little bit different. Rule number 3 and number 4 is a divergence. Rule number 1 and 2, it's the convergence. So when it confirms with that trend, it means that it is the price will follow the trend. With if you have convergence, some of you may not know what is convergence, right? Convergence means one is actually pointing downwards, the other one pointing upwards. So it is an opposite direction. Okay, it's like it is going to converge, the diverge together. So which is where this would most of the time shows a reversal signal.
Okay, the next question is, this one is also referring to your slides. The The question is, do long/high blue volume always indicate bullish? I think it's referring to your open interest, which you have blue and also red color bar.
Okay, depending on the charting platform, okay, some of the charting platform are open interest is only one color. It's like a volume, all only maybe all blue or all red or all black. Some charting platform is able to help you identify when when today's open interest is higher than yesterday's volume open interest, it shows one color. If it is lower than previous day, it shows another color. So it does not actually mean anything when price higher or the bar higher. But when it comes to when it comes to comparing who is taller or which one is higher, it's actually comparing with the previous day or previous few days. So to make it simple, when there is increasing in open interest, it means there is a strength for a bull, or whether there is a strength for the bear.
Okay, just now your slides, you did mention that for FKI, open interest doesn't apply. Why does all the rules, right, apply for FCPO but not for FKI? Maybe can you please elaborate a bit?
Okay, for FKLI, it does not apply is because we are trading, generally we only trade spot month, right? As well as, and then after spot month, the available month is actually the quarter months. So which is why, especially for Malaysia, FKLI market, most of the market participants are actually, it's either prop traders or retail traders. There is not significant of hedges in the market, so which is why you can see that most of the time the open interest are actually relatively quite flat there. It's unlike this FCPO market, which is the commodity futures market, whereby there are another one market participant which consists about, I think, 40 to 50% of the trading volume or open interest there, which is the hedges. So here, which is why at least in Malaysia FKLI market, it is open interest carries less meaningful interpretation there, because it's all flat. So whether there's increase or not increase, it does not carry significant or valuable information there.
Okay, the next question, right? He's giving some information. He's saying that the price, volume, and open interest rising. So the sentiment should be bullish. For a day trader, does the trend goes up in the morning or afternoon?
Okay, for day traders, open interest not relevant to you. Okay, because open interest, it is more relevant for those who are doing short-term trading, position trading, swing trading. So which is why when we look at open interest, we would just want to look at the end of the day only, because if for intraday traders, open interest, you can look at Bursa's website. I think it's on the main page. I think it's on the right hand side section where there is a derivative chart or price there, or you can find the derivatives, whether is it FKLI or FCPO, the opening, high, low, close, and then open interest section there. They will show the from opening market until closing market, the whole day's open interest. So one phenomenon that you are able to see is that during open market until mid of the day, open interest will increase, and then at the end of the day, open interest might be dropping already. So which is why open interest, it's not a meaningful indicator for intraday traders. It's more useful for those who are actually doing trend trading or swing trading.
Okay, the next question just now is, since you mentioned about Bursa website on the open interest, the question that many of them asking is, where can they get the open interest and volume via Bursa website? Can you remember?
Bursa
Exactly
website.
which page or which tab?
Bursa Malaysia. Hold on, I need to open on this. I think I can. In
Yes.
Bursa Malaysia, make sure you enter the correct website, bursamalaysia.com. And in this section, you can go to market information. So of course, if you just look at derivative price, right, if you we can click on it to see whether there is any information. Okay, here. So for example, for FCPO, we can have a search to see. You see all of the price. You see OI is open interest. And then if you were to, let's say, click on it here, you can see, okay, just now one audience asked about the open interest within the day, right? You can see when market opens, open interest increase. When market closes, it suddenly drops. So it does not provide any meaningful information here, because a lot of people doing day trading, right? So as long as you open one contract, 10 contracts or 50 contracts, open interest will definitely increasing. So it is not a meaningful information. So here, each and every contract, you can see that there would be different levels of open interest. So if you would like to get the day-to-day open interest, you can go to, I think, market information here, market statistics under derivatives. So here, historical data, you are able to get the daily data. So here you can actually download it, and inside you can find what is the open interest for that particular single day for all futures or even derivatives product.
Let's wrap up for today's session. Not only for today's session, upcoming, as I mentioned to you, we still have those webinar series on every Tuesday in different languages and covered by different speakers as well. So you can scan this QR code, or else in the chat box, there's a link provided by our admin. You can click on the link and save the link for your future usage. Then you can register the session accordingly. Now, once you click on the link, the events calendar, you can see all the events calendar. Please click on the Tuesday itself. You can see all the Tuesday in September month. Please select September because today is towards the end of August. Towards September, then you can select the respective Tuesday session for you to register accordingly. Now, not only that, just now many of you never trade futures before. This is definitely the class for y'all. The upcoming online workshop, this is meant for beginners. It's not meant for every of the participant in this session itself. It's only meant for beginners. If you seriously would like to get yourself started in futures trading and you would like to know how to get started, we have a step-by-step class for you to learn. And this is an online workshop. Unlike webinars, this one you are going to work more than the speaker is going to speak. So upcoming, we have both online workshop 1 and 2. You can go and register accordingly. It is advisable for you to finish the online workshop 1, the complete guide for beginners to futures trading with trading simulation, followed by workshop 2, how to create an effective futures trading plan, and also trading simulation. Similarly, you can scan the QR code, or else in the chat box, there's a link. You can click on the link to register. Now, this is the last part for the online workshop. Can you see you need to click on the events calendar, click on the Saturday, then you can access the respective online workshop for your registration. Now, last part for this DTS, Derivative Trading Simulator, if you would like to test in the virtual environment, not a real trading environment, with less risk or no risk at all, you can click on this bursamarketplace.com/mkt/DTS. This is provided by Bursa Malaysia, a virtual place for you to trade or kickstart your futures trading. The last one, Bursa Academy is a comprehensive one-stop e-learning platform. So whatever you need, those information, whatever you need to learn, you can access to it. And where can you get it? You can scan this QR code, or else you can access to bursaacademy.bursamarketplace.com. So this brings us to the end of our session. Thanks for CY for your nice presentation and very informative presentation. And thanks to all our participants online as well. We are going to see you in our next session. And take care and good night. Bye-bye.